Is it 50 to 1 if you have $10,000 in gold and $200 in silver? That is, in fact, rather practical. At the moment, silver is trading over 41, but I believe it has the capacity to move higher. Since there is a double peak at 50 that dates back to 1980, it does have genuine resistance there in addition to psychological difficulty. Once again, we were successful in 2011. Thus, silver has not yet made a splash. Despite gold's rise, silver remains within this range. Therefore, I anticipate that there will be some resistance from above. However, I believe that silver will quickly double to 100 once it breaks out over 50, and once we reach 51, 52, and 50 serves as support. A far larger drama is happening, as Peter Schiff of Schiff Gold explains, and it has nothing to do with the gold market. According to him, the true breakout happened in 2024, when gold unexpectedly broke through the $2,000 barrier and began to sneakily approach $3,000, taking Wall Street by surprise. Many analysts failed to notice the change and consequently downgraded market leaders such as Newmont and Barrick, thinking their run had ended. Rather than being a transitory upswing, Schiff argues that the recent performance of gold is indicative of systemic flaws in the banking sector. He claims that the United States' fiscal and monetary policies are becoming more irresponsible and hence the root of the problem. Similar to circumstances saw during the 2008 meltdown or the 2020 shutdown, the labor market has grown extremely vulnerable, as revealed by a recent dismal jobs report. Still, the Fed is getting ready to lower rates into a situation where inflation is already a problem, and it keeps praising the strength of the labor market. This is a turning point for Schiff. The dollar's credibility is under jeopardy as a result of the change in monetary policy dictated by political pressures. Gold, he says, will always be the most trusted asset by investors when confidence in paper money declines. The miners also provide clues about what's to come. Despite months of flat spot gold prices, mining stocks secretly climbed 30 to 40%, indicating a confidence level not witnessed in years. Schiff notes that miners have been among the best performers this year, with businesses like Newmont surpassing even the most powerful tech heavyweights in the S&P 500. Gold is still seen by mainstream investors as a fringe play, despite its power. According to Schiff, that disconnection is the most significant indicator. There may be an even more spectacular second phase of this gold cycle, as the larger market hasn't caught on yet. In order to ensure that you never miss an episode of Truth Meets Market, hit the bell icon and subscribe before we jump into Peter's astute observations from his most recent interview. Now, let's begin. After Trump's victory, many anticipated a decline in gold prices due to the optimistic outlook for the economy and Trump's promises to reduce the deficit and restore America's greatness. However, it is now abundantly clear that absolutely nothing of that was accurate. But I believe this to be a brand new leg. We devoted more than a decade. Keep in mind that the years 2001 to 2011 were the primary bull market years. Between 300 and 1,900, gold dropped below 300. Consequently, it multiplied by 6. Then, between 2011 and 2024, it truly veered off the rails. Between the years 2000 and 1500 to 1700, gold was traded. At first, it reverted to 1,000. By 2015, it had risen to 1,050. Thus, it held 1,000, rose again, but only achieved a new peak for a short while in 2020 due to the COVID issue. Its head popped up above 2,000, but it was severely injured and plummeted back down. Still, that massive foundation we laid in the year 2000 serves as a floor now due to the fact that it was resistant. The ceiling was the same. The support is now the focus. Another leg is about to begin, and I expect it will be similar to the last one. Consolidation occurred thusly between the years 300 and 1900. A six-fold increase, that was. Assuming a six-fold increase from 2000, that equates to 12 grand in gold. So, I suppose that's the general direction we're going in. We can go much higher if a dollar crisis and a US sovereign debt crisis occur. I also believe that there is a strong probability that it will occur. You inquired as to the motivation behind this. American fiscal and monetary policies are the root of the problem. Additionally, in light of today's lackluster jobs news, unless we're talking about a recession, the job market has never been this bad. Actually, the previous two instances of a similarly weak labor market were during the Great Recession of 2008 to 2009 and the financial crisis of 2009 to 2010, and in 2020 to 21, when the whole economy was closed due to the COVID pandemic. The Federal Reserve has been incorrectly describing the current job market. We have a very healthy labor market, Powell insisted. Our market is really robust. Throughout, he was completely incorrect. If we had transparent statistics, you would be able to see just how bad our job market is. However, this is not the case with us. Still, June saw a clear drop in employment even when adjusted for other factors. In June, we seen a loss of 13,000 jobs. Just 22,000 more were added in August. Production cut 13,000 jobs. Plus, there is an even more pertinent U6 unemployment rate of 8.1, which is higher than the headline rate of 4.3. Consequently, both unemployment and inflation are on the rise. The Federal Reserve has stated that the job market is robust, although inflation is low. They misunderstood. The job market is struggling. High levels of inflation are being experienced. This impending rate cut by the Federal Reserve in response to growing inflation is, in my opinion, the primary factor propelling the current gold price decline and dollar strength. Since inflation is already higher than their target and expected to continue growing, they will have to reduce spending. It is difficult to fathom when they have done this before. That is, it is counterproductive to their goals. In spite of the economy's weakness, inflation remains strong. The main objective should be to reduce inflation. However, political pressure to attempt to artificially revive the economy and the property market indicates that they will step down from that responsibility. Thus, gold is going to soar from this point on. We have a long way to go, and we've barely left the launch pad. Even though the price of gold was flat for 3 or 4 months, gold stocks rose 30 to 40% during that time. Because mining stock investors have never bought into the surge, that is something that has never happened over the whole bull market. Throughout, they have maintained their skepticism. They're coming to terms with the reality that gold prices will remain stable. However, neither the present nor the future price of gold is factored into the valuation of these gold stocks. They have priced in a crash though, so that's something. The general public agrees that this is a reasonable price for gold. Even if these stocks have increased by more than 90% year to date, we still need to bid them up because they are very inexpensive. Furthermore, the gold mining stock sector has outperformed all others so far this year, and nobody ever talks about them. They go unmentioned. As far as the S&P 500 is concerned, Newmont Mining is head and shoulders above the competition. Imagine that, the sole S&P 500 company that owns gold. Plus, it's outperforming every tech stock, but Newmont is likely the least owned stock in the S&P 500 compared to all of the other companies. If gold were to reach $10,000 and silver $200, the gold to silver ratio would fall to about 50 to 1, according to Peter Schiff. This is in line with historical averages and highlights the undervalued potential of silver. Although gold has broken out of its long consolidation, silver continues to confront the daunting $50 ceiling, which has been tested twice before, once during the 1980 boom and again in 2011. According to Schiff, this obstacle is more than just mental. Years of market experience are reflected in it. If silver were to break through, it would enter unexplored territory, where public opinion and market momentum might change drastically. Schiff claims that silver's ability to turn $50 into a floor is the key. The way up might open up at a breakneck pace if the breakout is convincing. The technical resistance over $50 is really modest, so the advance to $100 might happen in a few months instead of a long, arduous ascent. An explosive rally can be set up in this fashion, and investors tend to miss the signs of it until it's already underway. Schiff posits that silver is poised to make a significant and unprecedented leap in performance in the next stage of the precious metal cycle, maybe surpassing even gold. Due to this dynamic, is it 50 to 1 if you have $10,000 in gold and $200 in silver. That is, in fact, rather practical. In my opinion, silver has the ability to rise even farther than that, but it's currently over 41. Due to a double peak at 50 that dates back to 1980, there is actual resistance there as well as psychological difficulty. Once again, we were successful in 2011. Thus, silver has not yet made a splash. Despite gold's rise, silver remains within this range. Therefore, I anticipate that there will be some resistance from above. However, I believe that silver will quickly double to 100 once it breaks out over 50 and once we reach 51, 52, and 50 serves as support. I believe the relocation will be completed soon. It could happen within a few months. The moment we eliminate that obstacle, there is nothing left. Silver shorts, in my opinion, are going to run into serious problems when they attempt to pay their bets by purchasing silver that does not exist. I appreciate it when no one is paying attention to this bull market because it means Wall Street will likely buy in at a higher price point. No need for them to enter at this time. My clients need to get in right away. Plus, a lack of rivals is ideal. My only goal is to amass a large number of mining stocks, including gold and silver. Because of the added expense for my clients, the last thing I want is for Merrill Lynch and Goldman Sachs to advise all of their clients to buy. In my opinion, it is in their best interest to disregard this bull market for the foreseeable future. I have plenty of time. I patiently waited for this. Plus, I have no pressing need to expedite it at the moment. I take that as a good indicator that nobody is invested, nevertheless. Most people don't know. A small subset of the population is still very much interested in Bitcoin and is actively seeking it out as a medium of exchange rather than gold. I saw recently that he invested $50 million in gold, Kelly. Accordingly, perhaps he is coming to the conclusion that Bitcoin is a poor choice. Bitcoin is about 15% below its 2021 gold peak price, and it's interesting that it's hardly up today. Bitcoin has been losing value compared to gold for the past 4 years, despite the marketing hype, the establishment of exchange-traded funds, ETFs, the introduction of non-fungible tokens, NFTs, the Super Bowl ads, the celebrity endorsements, Donald Trump, the strategic Bitcoin reserve, the Bitcoin czar, and the transformation of Bitcoin into the world capital. Bitcoin doesn't even move up after all that pumping. So what is the meaning of that? However, gold and silver are also going up, although not to record levels. And this is the one thing that isn't receiving any attention. Accordingly, I believe these gold equities to be quite inexpensive. From here, they might potentially double again. Plus, I don't think they'd be too pricey, especially because gold is going to skyrocket if gold stocks double from here. That means they probably still wouldn't be where they ought to be. The silver market structure further enhances this possibility. The market's heavy short positions have been dragging prices down for some time, but a breakout would lead to short covering, which in turn would trigger a buying frenzy that would boost the surge. The market would be much more constrained due to the increased competition for ounces caused by physical supply limits. Among the most tightly wound prospects that are now accessible, Schiff characterized silver as such. The delay in its breakout has not been disputed, though. Investors' perspectives on assets and the monetary system they protect themselves from could be reshaped by a change that occurs now, as gold prices continue to soar and mining equities subtly outperform more prominent market sectors. The crucial issue, in his view, is whether investors will acknowledge this turning moment simultaneously or wait until the opportunity has passed before realizing its significance. My day is over now. Feel free to share your opinions in the space provided. Make sure to subscribe to our channel and enable alerts to be notified of any new videos we upload if you enjoyed this one and found it helpful. Watch this video and we'll see you later. The transcription was performed by turboscribe.ai. To get rid of this message, go for unlimited.